Today we're looking at the best dividend performing stocks on the market. Some of them should be on your wait list and maybe even in your portfolio. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Growth investors, bonjour, Mike Leroux here. You're listening to the Dividend Guy podcast. I am with my co-host Vero. How are you doing, Véronique, today?
Doing good, Mike. The sun is there finally as we record this for like 2-3 days. Awesome.
Yeah, it's there to stay. I mean, after like 3 weeks, a month of like rain almost every day? It's kind of crazy.
Yeah, right. So it's time to look back at what happened since January, and the word that best describes the first 6 months of 2025 is definitely volatility, not rain. And that in turn created fears among investors. So this mid-year wrap up is like a perfect reminder that not everything goes wrong and that many companies still deliver strong returns.
We decided to do that review a little bit faster than having the first 6 months completed, mostly because a lot of companies reported their earnings throughout the month of May for Q2. So it's a good time to take a look at what happened there. And again, keep in mind, when you look at year-to-date returns, it doesn't mean much. Even if you look at your year-to-date returns in November, I mean, it's 11 months. You should be investing for like 40, 50, 60 years. So it's still not much. But what is interesting here is to get an idea of like what is performing, what are the trends, and most importantly, understanding why some of those companies, as you mentioned, in a crazy volatile market, seems to be able to pop up and greatly outperform the overall market.
All right, so let's start with a quick overview of the market so far. If I focus on news and like the general speech and what my husband heard on the radio, the market should be down like 20%, which is not the case, right?
Yeah, that's kind of funny because you mentioned 20%. And I remember not too long ago hearing a lot of people talking about a bear market, which by definition is when the stock market drops by at least 20%. I mean, we're recording this like just a week in advance, but you never know what happens these days. But as of the time of recording, the Canadian market was up roughly 6-7% year to date, and the US market was pretty much flat. So, not too bad for all the bad
Right.
news, all the craziness, the tariff wars, and everything else. And yet, well, if you have stayed invested and you just lived under a rock and did not listen to news, well, you did the right choice. There is a big difference between news and numbers. So the thing is, bad news sells really well because it
Mhm.
hurts more to lose $1,000 than to make $1,000. So whenever you have like bad headlines, people are rushing to it, they're panicking, and it sells a lot. When you look at the real numbers, though, a lot of companies are actually doing well. So that's why it's super important to make the link between the narrative and the numbers, running into the financial statements, looking to quarterly earnings. And this is what we're going to do today a little bit more. I noticed that most people get stuck in the narrative and forget about the numbers. They're just like, yeah, but it's just like more trouble coming ahead, or like, yeah, but we're not done yet. And yes, we are never going to be done. That's the
Mhm. Right.
unfortunate truth. It's also important, though, to mention that it's not the case for all companies. I'm not trying
Mhm.
to paint a pinky landscape here. Some companies are struggling right now. Some companies reported bad quarters. Even some of them cut their dividend. We may or may not do an episode on that later on, BC. So just to say that it's not all great, it's not all bad, but it's pretty much the market being the market.
So, Mike, what creates this volatility?
Well, in general, the volatility is created by its fair share of uncertainties. When investors are not fairly confident about what's going to happen. What's even worse since the beginning of the year is conflicting information, which of course contribute to boost uncertainties.
Mhm.
So we got, I don't know, 122 different announcements about tariffs so far. And I'm pretty sure we're going to have like a great, I don't know, maybe another 100 new announcement because we're definitely not done yet. So the market is having a hard time trying to figure out what's going to happen next, and even like what's going to happen in the next 2 weeks. So
Mhm.
that's why on a good announcement, the market goes up. On a bad one, people are selling and they're not too sure what's going to happen. I have actually a different example that is also valid. If you look at Alimentation Couche-Tard, there's been ongoing narrative about Couche-Tard trying to acquire the 7-Eleven convenience stores from 7 and I. This news started around August of 2024. So
Mhm.
we're getting close to have like a full year of news here. We're going to make it. We're not going to make it. Oh, it's getting complicated. Oh, it's not going to be complicated. And investors, the market in general, have a focus on like short term. So, short term wise, a company telling you we're going to issue more units, not units, but more shares. So, we're going to dilute value for shareholders and we're going to issue more debt to make an acquisition, well, that doesn't sound like a great idea, especially short term. And
Mhm.
for that reason, investors are starting to like sell shares of Couche-Tard. They're just like, yeah, I don't want to get stuck there while the company will issue more shares, get into debt. Maybe there will be an integration risk. Maybe it's not going to be as good as previous acquisitions or whatever reason. They're not too sure, but they don't want to take the risk. And last week, towards the end of May, we had a news where it was going to be more difficult for Couche-Tard to acquire 7-Eleven because the shareholders of 7 and I approved the new plan, approved the new management in place. And then, because there were less chance of seeing Couche-Tard issuing shares and debt to make the acquisition, the stock price jumped almost 5% in a single day. So just to show you how sometimes a single news, and honestly, we're making a big fuss out of that, in 25 years, we're barely going to talk about this moment in Couche-Tard's history. Like, we're just
Right.
going to say either we're going to like go back in time and we are either going to say, oh, they bought 7-Eleven, it was great or it was bad, or they didn't buy it and move on. Nobody talks about the fact that Alimentation Couche-Tard about, I don't know, like 10 or 15 years ago, tried to bought Casey's. And Casey's, I mean, we did a show on that a few months ago. Great convenience store in the US, and nobody talks about it anymore. I mean, they tried to make a big deal. The deal didn't go through. End of the story. It becomes like a
Right.
blip in Couche-Tard's history, and it's completely irrelevant today. Well, guess what? Tariffs war. It's going to be the same thing in 25 years. So at one point, short-term focus creates that volatility. If you're a long-term investor, you just have to like turn off the noise. Don't listen to the radio or YouTube or anything else, and just stay focused on your stuff, and you're gonna be good.
All right, so let's continue with real examples again. Many Canadian stocks in the material sector have performed well. It's the case for Franco Nevada, FNV.TO, Wheaton Precious Metal, WPF.TO, Agnico Eagle, AEM.TO, and Nutrien, NTR.TO. How would you describe their performances, Mike?
And when we've been nice with you, Vero, because we could have like listed the entire, I don't know, like 40 stocks, gold mining stocks on the Canadian market, and have you say each of those ticker one by one, because everything gold turned into more gold since the beginning of the year. Of course, because when you invest in gold, you make a play on fear and volatility. And there you go. There was a lot of fear and a lot of volatility, so you had those gold mining stocks such as Agnico Eagle. That is a pure play on gold. It's a mining company. It's a big player, so they have this ability to acquire more assets, so more mines or literally more companies, and they are able to do that at a large scale. So whenever the gold price goes up, well, they are making a killing. It's still a highly volatile stock, definitely not part of like the type of companies that I appreciate based on my investment strategy. But for someone who follows like gold price and this industry, man, that was a lot of money to be made with those gold miners. On the other
Mhm.
side, you also have streamers, which are a little bit more tempting in my taste. So you have like Wheaton and Franco Nevada. They are both streamers. So what it means is they own assets, they own like piece of lands where definitely they are like precious metals, mostly gold, sometimes like silver, palladiums, and other metals. And what they do is that they let gold mining companies to take the exploration and the mining risk. They receive a royalty in exchange. So they will not perform as well during like gold rushes
Mhm.
versus a gold mining company, but they will also do a lot better when there is a slowdown. Interesting to mention, both Wheaton and Franco Nevada has no debt, so they have like very solid balance sheets. So for them, it's more a matter of being able to renew their asset portfolio than anything else, because as long as the royalty is coming in, they don't have to worry about too much. Wheaton is a little bit more volatile. They cut their dividend in the past, but right now they have more momentum. For Franco Nevada is a lot more stable in terms of business model. Never cut their dividend. They're on a long streak actually, but they had offered a bit of a less growth, especially in 2024, mostly because one of their most important mine, Cobre Panama, has been closed, and they have like problems over there with the government of Panama, and it's still not settled. So for that reason, yes, it's up this year, but they're more in recovery mode. And Wheaton and Agnico Eagle has been skyrocketing for almost 2 years now. Now for Nutrien is completely different story. I mean, of course, they are selling fertilizers, so that has nothing to do with gold. Still in the same sector, though. And the problem with Nutrien is they suffered a lot as the fertilizer prices went down since 2021, I think, 2022. So the stock price it rock bottom, and now it's kind of like trying to recover. But if you bought it like 2-3 years ago, you're still in the red. So not exactly a super performer for a longer period of time, but right now it's getting a little bit better. So there's probably a little bit more upside as long as fertilizer prices keep going up. I mean, unfortunately, it's usually the same story. Commodity price goes up, those companies will make you like a genius. They go down, you're gonna suffer, and that's unfortunately the story here.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you. So please spread the love. Thank you.
Right. So now let's move to the industrial. On the Canadian side, Finning International, FTT.to, and Stantec, STN.to, led the way. How is it so, Mike?
So those two companies benefit from the perfect combination of having a strong narrative and strong numbers. So the narrative here is, of course, big play on infrastructure. Both Canada and the United States are investing massively in their infrastructure. So when you're selling equipment or you're selling engineering services, well, there you go. You can benefit from this tailwind. The numbers were also very good. So for Finning International, they are one of the largest Caterpillar's dealership. About 50% of their revenues coming from Canada, 33% from South America, and the rest from UK and Ireland. In the recent quarter, the revenue was up 9% and earnings per share was up 18%. They even wrap up the quarter with a dividend increase of 10%. And most of the revenue growth was coming from South America, where they show 42% increase. So long story short, when you have good numbers, it's a lot easier to convince investors to buy your stocks, right? So there is a big interest for Finning International for that reason. And exactly the same story happened with Stantec. So Stantec is a global engineering firm. They are taking care of all steps from planning, executing, constructing, the maintenance, and also the decommission of any type of asset. So they work in infrastructure and buildings, energy and resources, water, environmental services. The latest quarter, the revenue was up 13%, earnings per share up 29%. And what I like about this one is there is a mix of organic and acquisition, growth by acquisition. So organic growth for the last quarter was 6%, and acquisition was 3%. So it's interesting to see this engineering firms being able to grow their business and then kind of like boost their returns with adding like smaller firms to their portfolio. If you look at the dividend triangle, so the trends for the revenue, the earnings, and the dividend, well, everything goes up almost steady every single year. And it's not about to end because they show an increase of their backlog. So the orders that are coming up keeps on growing. So it tells you that revenues and earnings are likely going to follow. And naturally, if earnings per share keeps on growing, you can bet that the stock price should probably follow about the same trend at the same time. So definitely two companies that are doing well. and benefit from a positive narrative. So you have the reason why they outperform the market at this point.
On the US market, you pulled out Deere, DE, which everyone knows for its green tractors. You also wanted to discuss a company that has never been mentioned on the show before, Rollins, ROL. So let me know what it is and why are they both interesting so far this year.
Yeah, it's one of the advantage of running a investors membership website with more than 4,000 investors is from time to time you have members that are coming up with companies that you barely know or never saw on your radar, and they're just like, "Hey Mike, what's your thought on Rollins?" But I'm going to let you wait a little bit more. We're going to talk about Deer first and then we're going to go over Rollins. But seriously, the wait will be worth your while. So, Deer, well, everyone knows it. And it's interesting on this one because the latest quarter was bad. Revenue and earnings were down double digit. It was better than expected, but still not necessarily good news, right? I mean, they're literally saying, yeah, we're selling less stuff and we're making less profit. So buy our stocks. What happened is the narrative is very strong. The shift that Deere is making right now is a shift towards more technology and autonomous tractor to compensate for the lack of farmers. They recently made an acquisition of Centura, which does remote imagery tools for agriculture as well. So the point is not to sell equipment to farmers anymore, but to enhance technology to make farming more productive and becoming like or staying the leader in this market. So the narrative is very strong. And in this case, the market is forward looking instead of looking at what really just happened over the past few months. As for Rollins, interesting business actually. I was fascinated to see that I always thought that it was just like mom and pop shops. They're doing pest control. So for residential and commercial, but of course you can imagine that they have a large network and they grow organically and through acquisitions. So again, highly fragmented market that enables them to buy competitors or those small mom and pop shops all around North America. And what is great about pest control is, well, it's recurring and stable, right? If you're willing to pay once to take care of it, after that, you kind of have like that kind of like maintenance fee where they just come around, do their stuff, and protect your house or protect your building. I know that for a fact because I'm paying every year to make sure that I do not have ants coming into my house. So every spring, I'm almost happy to pay for that like pest control. It's just like prevention at this point, but we have like a lot of woods, a lot of dead woods. That brings a lot of ants. So you just want to make sure that they don't come in. So there you go. Again, in this case, very stable business. But the proof here is really in the numbers. The latest quarter, revenue and earnings per share was up 10% each. The guidance for the rest of the year is between 10 to 12. And if you look at the dividend triangle, is like it looks like a Hot Wheel launch ramp. Like it just like goes up forever and ever, like for the past 10 years. So beautiful, low yield, high growth type of business in a very recession resistant industry. Definitely one that I'm going to take a look a little bit more on, even though it seems that the good money is gone because it's been like going up for the past 10 years. It doesn't seem that it's going to slow down anytime soon. So definitely one that you should be put on your list to do a little bit more of a deep dive to see if it could fit your portfolio.
That kind of stories always amaze me, like pest control, and now you're on the stock market and people talk about you on a podcast. That's amazing.
Yeah, seriously. I mean, I'm pretty sure that the company I deal with, they probably have like 5 employees and they're just taking care of
Right.
like their city and the surrounding, or I don't know. And now on the other side, you have like Rollins with a market cap of like $27 billion. I don't
Wow.
know. It's just, yeah, it's crazy.
Wow. All right. So you noticed one candidate in the energy sector, which is TerraVest, TVK.to. Why does it stand out?
Well, full disclosure, this one I have it in my portfolio. I bought in my RSP, I don't know, like a year, 18 months ago, and it just exploded. I mean, it was exploding back then and it keeps on exploding. That's just crazy. So TerraVest Industries is not really an energy stock in a sense that it's not a pipeline business. It's not oil and gas exploration. What they do is they manufacture home heating products, propane tanks, like any tanks to transport natural gas, basically, storage tanks as well. natural gas liquid transport vehicles. So everything about like storing and transporting physically the natural gas. So we have again a story where as we want to move more towards natural gas for as an energy source, well, you're going to sell more tanks. And as a bonus, what they do is they add maintenance and servicing fees. So now they have like a business that is a little bit more recurring on that part. The margins are really good on that side too. And since it's a relatively small market, which is highly fragmented, they grow also by acquisition. Right now, it's kind of like the perfect mix of a good story with good organic growth. And on top of that, growth by acquisition. Just be careful because not too long ago, before the stock exploded, it was considered as a small cap. Now the company's getting out above 3 billions in market cap. So it's not as small as it used to, but still not that big. So this is the type of
Right.
companies that is skyrocketing right now. Don't be like surprised if the stock price drop by 30% at one point. This often happens when a company goes up too fast and it is a small cap as well. So I just want to highlight the risk before you start jumping and buying some shares because you see the stock price going up like there's no tomorrow.
All right, Mike, we have discussed like three sectors that are not usually your favorites, and most of these companies are not your usual suspects either. So, why do you think these sectors and companies performed better than others so far?
Well, in terms of sectors, it's true that I'm definitely not a big fan of materials and energy. For industrial, they are cyclical, but I can live with those. But yeah, I have a very small exposure, almost close to none in my portfolio for both. But what makes them so attractive or unattractive is actually because they go with like big highs and big lows. So if you follow those markets, it's going to catch your intention and then you're going to know, oh, I'm going to buy because right now it's been like 2 years. It's a dead market. The stock price going down like there's no tomorrow. And it's probably a good time to buy at this point before like the next big jump. So big cycles makes a lot of people super passionate about those topics as well, which is good. It's just not close to my investment strategy. And here's a good example. I bought Nutrient in my Smith Maneuver. And then again, sometimes people are just like, they're putting words in my mouth. They're just like, oh, Mike has like Nutrient in his portfolio. I'm like, yeah, that's like 30% of my entire assets. So, yes, I do have it, but come on, guys, it's not really a position. I started the Smith Maneuver portfolio by putting $500 per month in stocks, and I used one of those $500 to buy a few shares. I did it after the stock price dropped as a speculative play, and kind of interesting because I'm in positive right now, but not by that much. So just to show you that it does not always work that well either. So yes, you can make a lot of money and it's going to make like great stories to tell, but a lot of times you're going to buy them and they're not going to do that much. And this is pretty much the case with Nutrient. Like sometimes I was showing like 20% profit and then 0 and then 5 and then minus 10. So, anyways, it was just like a few $100. I don't really mind about this one. I would definitely not be making Nutrient like a full position in my portfolio, reading like a 3% position in it. But at this stage, I don't really mind. But that's what's interesting about those sectors. The fact that they are cyclical, from time to time, they will look like the best sectors ever. And some other times, not so much. If you look at the energy sector as a whole, over the past 2 years, they didn't do much. I mean, they were crazy great investment between 2020 and 2022. 23, 24 wasn't that great. 25, not really. I mean, the oil barrel is hovering around 60, barely not even making it to $70 these days. So most companies will remain profitable at this level, but they're not going to thrive. And this is what's happening. So just be careful when you look at short-term results, thinking that those companies are going to be the next big thing. Maybe the easy money is gone and then you're left with not much to hold on to.
Now, in the healthcare sector, McKesson, MCK, and HCA. Guys, you have no ideas how many times I've tried this one. HCA Healthcare were your top performers, Mike. And I'm sorry that I'm laughing, but this is crazy. Why should investors look at them? So I'm repeating McKesson, MCK, and HCA Healthcare. All right, we got it.
Are you sure? That was fun. I swear to you, listeners, we have like a good 2 minutes of bloopers about this one. It's just like, it's marvelous. But you're not going to listen to it. We're just gonna have fun on our side. Yeah, so healthcare sector. Ironically, while United Healthcare UNH, I'm scared to say the tickers, is down 40%. These two are rolling. So Mekison, diversified healthcare service provider, making a lot of money in a highly complex business. So they benefit from economies of scales by distributing a lot of like products to like pharmaceutical products. What is great over the last quarters is they benefit from a high prescription volume growth. They have like their distribution specialty products that is doing well also. And the thing is, with population aging, the need for more drugs is obvious. So, and they're distributing it. So it's kind of like the perfect scenario for them. Great dividend triangle. Another case of like strong narrative and strong metrics. Well, boom, you have Mckesson doing incredibly well in the stock market, not just this year, but for the past few years, actually. For HCA, shout out to Dave, a DSR member, who actually put this one on my radar. And he was like, yeah, Mike, it's like, you don't even follow this one at DSR. How come? Another case of like low yield, high growth stock. HCA is the largest hospital operator in the US, mostly based in Florida and Texas. Latest quarter with revenue up 6%, earnings per share up 20%. So similar to Mckesson, they benefit from that demographic trend where people are aging, the rise for healthcare services, and they have been able to manage those hospitals in a very great way, showing incredibly strong dividend triangle again. So if you are looking for a play in the healthcare sector and you're tired of looking at the classic big pharmaceuticals such as Johnson Johnson, AbbVie, Merck, or Pfizer, well, you do have two options, definitely lower yield, but highly performant with Mckesson and HCA Healthcare.
Listeners, let's empower you in the investment world with our free dividend rockstar list, which includes stock ideas with positive dividend triangles. How does the list help investors, Mike?
You know, Vero, we survey regularly our members and our readers, and we ask them what are their biggest struggle. And one that keeps coming back is really the buy struggle. Most investors don't know what to buy, they don't know when to buy it, and the Rockstar list will help them grow a little bit more their conviction, because that list of stock will just include companies that show great financial metrics. Of course, you cannot start by picking them blindly, but it's a pretty good start to make sure that the company that you're about to read and know their business model is actually a business showing revenue growth, earnings growth, and dividend growth. The way I use it usually is I will filter it by sector to identify a sector that I want to have more exposure to, and then I just look for companies that have the strongest dividend growth model.
To download the list, enter your name and email at thedividendguyblog.com/rockstar. Again, hit pause now and go to thedividendguyblog.com/rockstar.
All right, so you selected two companies in the consumer staples sector. Again, not the typical Alimentation Couche-Tard and Dollarama. Instead, you selected Maple Leafs Food, MFI, and Philip Morris, PM, which I must admit I was shocked to see on your list. So why did you choose them?
Well, that was kind of the point of doing this podcast, right? I mean, trying to explore new companies that are actually doing well. So sharing like some positive news. I could have picked Dollarama because it's up 25% this year. So fair point.
Yay.
This one could have made the list. You hold it, right? So that's why
Right.
you're smiling. This one is a beast, continues to be a beast, but I just wanted to go elsewhere, and definitely not going to talk about Couche-Tard because again, this year it sucks. I mentioned earlier the share was up 5%, but year to date is actually down roughly 10% or something like that. Still a lot of like uncertainties around this one. I haven't like dropped the ball on it at all. And we're going to maybe talk about it later or another episode because I just love to talk about Couche-Tard. But let's bring the spotlight on two other well-performing companies this year. Maple Leafs. I was surprised to see the Leafs like scoring at one point. So sorry guys, bad joke. I couldn't help myself. I really just couldn't. I was rooting for the Leafs this year, to be honest. I was disappointed that they lost. But anyway, that's beyond the point. Maple Leafs. It's more than a recovery than anything else though. If you look at the stock price, and this sometimes happens when the stock price goes down so fast for so long, there's a recovery point. It's not necessarily going to fully recover, but if you put if you select like the lowest point and then you look at the highest point, then you just have the impression that this company is thriving. It's getting better, to be fair. Revenue was up 8% during the last quarter. Earnings were also getting better a little bit. So if you look at the dividend triangle, that's been a rough ride over the past 2 years. Now it seems to do a little bit better. It's still not one of my favorite. I have not a problem, but I don't necessarily see how like those food companies that are kind of squeezed between the consumer and the grocery stores. It's hard to make good margin. It's hard to grow because there's a lot of competitions as well. Consumers are looking at every dollars of their budget for groceries because it costs so much. I find it's a difficult industry to grow fast. It's not that I dislike this company, but I would not buy it for those reasons. I'm kind of like neutral negative, if I can put it that way, but I would not buy this type of business for that reason. As for Philip Morris, I was shocked, surprised. I mean, I thought this business was dead, but no, I mean, back from the dead, zombie business, super strong these days. Actually, the dividend triangle is getting better and better, which is kind of surprising. The company is growing its revenue, of course, with those smoke-free products, but that's like growing very fast. We're talking double-digit growth. So I still don't like the narrative around this business, but definitely the numbers are telling me that I'm wrong on this one. So see, that's an interesting play where it's important as an investor to have a high level of conviction in the narrative, and then you have the numbers that will back it up. So for me, when I look at the numbers, if I just look at the dividend triangle and I don't even know I'm looking at Philip Morris numbers, I might be tempted to invest in that company because the past 2 years they were strong. And I'm like, yeah, I mean, this company seems to be a business that I would love to have in my portfolio, but I don't have this level of conviction. And I mean, being confident in something or not being confident is all about like personal perceptions, right? So I just don't believe it can grow, but it doesn't mean that it cannot. So that's a good proof where when someone is telling you, "Oh, I like this stock and you should buy it," well, maybe it's all about his perceptions versus somebody else who's going to tell you, "Well, it's not worth a penny." And then it was a good investment. That's why we always keep saying do your due diligence, because maybe you're going to analyze Philip Morris and you're going to believe in that investment thesis and you're going to be super happy to have it in your portfolio. And it's all good as well because there's no right or wrong here. There's just like knowing what you own and why you own it.
All right, finally, we can't do this episode without having at least one candidate in the financial sector. You went for TD Bank this time. Why?
Well, because National Bank dropped and now it's coming back. But I mean, year to date, not a super performer, but it's all right. It's all right. I mean, I can talk about other banks. I don't mind. Jokes aside, TD had a really rough year in 24 and they're making a strong comeback. This one is again more about the future narrative, not necessarily like the latest performance. I mean, latest performance wasn't that bad. They reported on May 22nd. Actually, the big news, the big impact was the sale of the Charles Schwab assets that brought in more than 8 billions in gains. So a lot of money for TD to rearrange its balance sheet. They're going through a massive US bank restructuring right now. It will also help to pay for additional fees, having like regulators looking over their shoulders. So all of this was quite positive for the bank. In general, though, in Canada, their net income was down 4%, but they were saved also by wealth management up 14% and wholesale banking at 1%. So it was good overall in terms of quarter. Not crazy good if you put the fact aside that they will not sell Charles Schwab's assets over and over. So that was like a one-time event, a big load of cash. Going forward, it's going to be okay, but it's more about having this comeback for the TD Bank. So hopefully they're going to continue on that wave and they're going to be able to spin a bad story, a nightmare, into a positive one going down the road.
So when we say that these companies are among the best performers this year, it may sound like the easy money is gone, right? So is it still time to invest in them?
I always like to say that it's important to look at the long run, not the short term. In this case, they are not all up for the same reason either. Some of them are on a temporary momentum, such as like the gold mining stock that we discussed and the streamers. So Agnico Eagle, Franco Nevada, Wheaton. they're all up on that momentum right now. If everything stabilizes and we have less uncertainties, maybe they're going to also slow down and it's not going to be like the best thing ever. But on the other side, if the gold price keeps on going up, well, there's still a lot ahead for them. Some others that we have discussed today are based on some great narratives for the future. That includes Philip Morris, Deere, also TD, I would say. But TD is like halfway about the narrative for the future and halfway of like the fact that they are recovering. So Nutrient, Maple Leaf Foods have not been great investment over the past 3-5 years, but right now over the past few months they are recovering for a part. So maybe there are a little bit more money left to be made on those as they may continue to recover. And some others are just showing great momentum and great short-term returns and great dividend triangle. So TerraVest, HCA, Mekisen, Rollins, Stentec, Finning International, they all show consistent results over the past few years, some of them over the past 5 and even 10 years. When you look at HCA or Rollins, they've been very solid for a long while. It's actually a crime that they have not been hitting on my radar any, like sooner than this, but cannot see all of those, right? It's also important to not give a value to your investment idea or a stock in your portfolio based on short-term performance. In other words, I'm not a genius because TerraVest Industries has more than doubled my portfolio over the past year or so. I mean, it's fun, it's great, but it's short term. It's a great company because it operates in a market that is in high demand. There's a lot of growth by acquisition to be made because it's a fragmented market, and they're adding maintenance fees to their customers. So it brings more stability, higher margin products. So that's great. But now, is it going to continue to skyrocket for the next 5 years? I don't know. So I cannot give a value just on short-term performance, but I can appreciate the business model and the process behind it. On the other side, Couche-Tard, not to name it, is not a bad stock because it has not performed as well as the market over the past 2 years. I mean, it's still a business that has more than doubled in my portfolio, still did very well for the long run. Right now, they're not doing that great, but it's not the first time. I mean, I've seen a lot of companies being dead money for 1, 2, 3 years and then exploding. And then everybody's like, oh my God, like that's an amazing business. Well, not necessarily amazing because the stock price goes up or goes down. You have to really look at the business model, look at the numbers, and the stock price is just whatever happens in the meantime.
So, Mike, we often talk about red flags, but what would be the signs to make you think that these companies will continue to perform for decades and not just because of the current context?
Well, as you know, I'm not a big fan of trends. So I'm trying to focus a little bit more on companies that will have this kind of like perfect match that we have discussed for some companies today with a very strong narrative and also very strong numbers. Because if you have just the narrative, well, you're hoping that the numbers are going to come up. Sometimes it does, sometimes it doesn't. It's just like, yeah, that's like cannabis going to be the next big thing. Big fail. AI right now is working so far. So you never know how it's going to happen. But when you have like the combination of, oh, I have like obvious tailwinds, but the numbers are there to back it up, this is where I think it's the best. If you're just looking at companies that are highly cyclical, well, they come and go, and people are very loud about them when they go up, and they go very quiet about them when it's not working. So that's also a good sign to see maybe you're about to invest in a red flag business, is when a lot of investors are yapping that it's the next eighth wonder of the world, and they go like completely dead silence whenever the stock price goes down.
Well, thank you, Mike, for this half-year review and for shedding some light on stocks I wasn't aware of. Listeners, to discover other stock ideas that meet your growth criteria, download our Dividend Rockstar list, which features approximately 300 dividend growth stocks with positive 5-year revenue, earnings, and dividend growth. Now available at thedividendguideblog.com/rockstar. For our show notes and related content, visit thedividendguideblog.com/230. Next week, we will discuss the elephant in the room, telcos, PCE. Make sure you do not miss it. Hit the subscribe button underneath our podcast logo and leave us a 5-star rating. Until then, stay invested.
Stay invested. Hey, fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.